Hello there. Welcome back to Financial Accounting L6. In this video, I want to look at question one of a November question paper. So we are going to look mainly on the theoretical aspects of Financial Accounting L6. So of course, we should not forget to subscribe and share to our channel and share the link to our colleagues who are doing Financial Accounting L6. So looking at this video, we're going to start on the multiple choice section. This is going to well prepare you for the upcoming exams. So good luck in your exams. So with the first question that we have, I want our multiple choice section, and maybe we can try to zoom out. So we have 1.1.1 is our first question. So our first question reads, what is the general ledger entry for the payment of VAT when it is payable to SARS? So remember, we enter VAT or adjust VAT in the VAT control account. So the situation that we have in that scenario, we are going to have our VAT in the form of a T account, VAT control. So basically, this is our VAT control. So you'd see that we have output VAT on the credit side. Output VAT entered on the credit side, and then we've got input VAT on the debit side. So with that, now we see if we have a scenario, we'll see the scenario that we are given. This is general ledger entry for the payment of VAT when it is payable to SARS. So when it's payable to SARS, it means we are having more. When it's payable to SARS, we are having a scenario whereby output is greater than input. So when we have such a scenario, we are it's supposed to be payable to SARS. So in this scenario now, it means we will be having a smaller total on the debit side, and the output will be greater. So our balancing figure will now be payable. Here will come as our balance CD in the VAT control, whereby the CD will be the amount payable to SARS. So that's the scenario that way. So obviously, the double entry that we're going to pick, we should debit a VAT control on this part, and then we debit a VAT control, and then we credit a bank since we are paying to SARS. So it means that the money is going to be paid through bank. So debit VAT control and credit bank. So when it's payable by SARS now, if SARS is supposed to pay us as a company, we are supposed to credit the VAT control, and then we debit the bank. So we take note of that double entry. So this is what we have on this part. So we have our answer is D. So moving on to number two, which following is not an example of cash and cash equivalents. We know that cash and cash equivalents represents the actual cash position that we have in the business. So if you check according to the responses that we have, you'll see that we have got cash float, which is part of our cash and cash equivalents. We have got petty cash, also part of that. We have a favorable bank balance. A favorable bank balance means it is a debit balance. So when it's a debit balance, it's also part of a cash and cash equivalent. But when it becomes a credit balance of bank balance, which is now an unfavorable bank balance, that unfavorable bank balance is a bank overdraft. So a bank overdraft is an unfavorable position in terms of a bank balance. So with that, we see now that the bank overdraft won't be part of the cash and cash equivalent, since we regard it as a current liability. Remember, the scenario that we have under a bank overdraft is that our money has been withdrawn from our bank account more than what we have in the account. So our account has been left in a negative balance. So in that scenario, it now becomes a current liability. We take note that also that when you go to the balance sheet now, the bank overdraft will go under current liabilities. So this is what we have for this part. So we have our correct response as D. which is not part of cash and cash equivalents. Then moving down, we have got 1.1.3. Dash includes goods that are held for sale in the ordinary course of business. Goods that are held for sale in the ordinary course of the business. So you'd see that and the goods that are held for sale is inventory. So whenever we buy goods with the intention of reselling them, I would call it inventory or stock. So meaning the same thing, it means our inventory. Alternatively, we can call our inventory stock. So it makes a D the correct response. Moving on, number 4, I used the following information that appeared in the financial records of Alpha Limited and choose the correct amount indicated below of the dividends declared. So let's take note, we need to calculate the dividends are declared. So this dividend declared that we are going to calculate will include what was declared for ordinary dividends plus the one that is going to be declared for preference dividends. So we see what we have on that part. So we are given the balances. Then what is important is how we are going to pay. For example, the ordinary share dividend. Now they are saying the directors declared a dividend of 10 cents per ordinary share in 31 December 2015. Then we check how many shares do we have for ordinary shares to get the ordinary dividend. So we multiply by 10% one times the total for ordinary shares. So if you come here, you see that ordinary shares, the figure that we have for total shares for ordinary shares, we've got 100,000 is indicated here. So it means on ordinary dividends, we are going to say ordinary dividends, it's equal to our 100,000 shares, which we have on this part, and then we multiply by the 10 cents that we are given, which is 10 cents. Obviously, it's 10 over 100. 10 over 100, we convert it to a decimal, it becomes 0.1. So we multiply by 0.1. We get your answer is 10,000 declared dividends for ordinary dividends. Then now we see that we also have our preference dividend. So now we calculate the preference dividends part, whereby we are told that 10% preference shares issued at 150 each. So the 10% indicates the 10% that we have will now indicate the preference shares, and we are seeing that the preference shares is 150 each. So basically it becomes easy. So what we are going to do now is we first say 100,000 times 150, and then we're going to get it as 150,000 rands, and then so that's how we are going to get our preference. So we just say the 10% times the total value, or you can say 10% of 10,000, 100,000, then you get 10,000. The 10,000 we multiply by 150, you get to 15,000, which is the same answer. So it's simple. We can just say our 10% times the total value, which is 150,000. So it means we have got 25,000 as our preference dividends that were declared. So, and now to get the total dividends declared now. Total dividends declared, we are now saying, here we're getting 15,000. So this one is a mistake. We can correct it on this part. We have 15,000. So for total dividend declared now, we are saying 10,000. And then we add your 15,000. And then you're going to get your total is 25,000. So this is exactly what we have on this part. So 25,000 we are having on D. So we have D as the correct one for that part. And moving on to the next question, which is now 1.1.5. So 1.1.5, which amount of dividends mentioned in question 1.1.4 will be part of the current liability in the statement of the financial position if 5,000 was paid. So we take note that 5,000 was paid. But we have calculated the total dividends are declared, and we got 25,000. So it means out of 25,000, we are being told that 5,000 was only paid. So it means we subtract that 5,000 that was paid, then we are left with what is that was declared and not yet paid, which is now 20,000. So the 20,000 becomes the amount of dividends that is still owing. So that will become a current liability as indicated. So this is what we have. So we have about 20,000 on C. So C becomes the correct response on number 5. Then we go to number 6. How much will be the amount payable refundable to or by SARS if original balance was 140,000 credit balance? So we indicate again, it's simple as you present it in a T account in the SARS, the VAT control. The VAT control, remember, we have highlighted it, VAT control. So in the VAT control, this is a credit balance. So we have got 40,000 on the credit side. Then provisional tax payment is an amount that has been paid. So we have paid as a business, so we're supposed to debit the VAT control and credit bank. So put it on the debit side. Then income tax assessment will come on the credit side. So basically this is the scenario that we have on that part. And then now to calculate now the amounts are payable. This one is going to be payable to SARS. Payable to SARS because we are having the credit being greater than debit. So we are supposed to debit VAT control and then we credit our bank. So in this case, we now balance it. We see that 40, we have got 40 plus 50, we are getting 90. And then now we say your 90 will be in between the double lines. So we have 90. And then the balancing figure now is the one that is payable to SARS. Is now going to be 90,000 minus 10,000. Then you get your balancing figure is 80,000. So we have our 80,000 on A. So having that now, we move on to the next question, which is going to be 1.1.7. Choose the provision for bad debts for 2015 indicated below. Using the following information, we are given data control 120,000 additional bad debts written or are not yet recorded 30,000. So when it's not yet recorded, it means it's not yet subtracted from data control. Remember, whenever we've got a bad debt, we are writing off that data out of our books because we've come to a conclusion that this data will no longer pay us. So we know the books were supposed to subtract this 3,000 since it was not yet recorded. But if it was recorded, we're not going to subtract. So we're going to 120,000 minus 3,000. Then the answer that we get, we multiplied by 5% as the rate given. So as simple as that, we are saying 5% multiplied by, in brackets, 120,000 minus 3,000. So let's calculate it within the context and see what we get. So it's that we're going to get 5,850, which is on A. So exactly as we have for that one. Then we go to number 8. Using the information in question 1.1.7, indicate the provision for bad debts adjustment for 2016. If the provision for bad debts was calculated as 3,500 for 2016, will the provision for bad debts adjustment be in income or expense? So very important. When you're indicating it as an income or expense, remember when you calculate the adjustment or provision, you're supposed to identify whether there is an increase or a decrease. So when it becomes, when you get, we see that there is an increase. When you see that it is an increase, it will be an expense. When you see that it's a decrease, it will be income. So basically, this is what we have for this part. So with that now, we check according to what we have. So we go back to 1.1.7. So 1.1.7, we are being told that this is 2015. So the one that we've calculated is for 2015, which we got is 5,850. And then going to 2016, it's now 3,500. So basically, it's a movement from 5,850 to 3,500. So that's the movement that we have, which is indicating a what? A decrease. So when it's a decrease, it becomes income. So to find the decrease, you're now saying 5,850 minus 2,500. And with that, you're supposed to get your answer is 2,350, which you will see. So moving on to number 9, how much is retained income at the end of the year, 30 June 2016, if you are given this scenario, the retained income at the end, we are given the retained income at the beginning, and then we are given transfer from general reserve to retained income. You see now, so this one is a transfer, so it's going to be a plus to the opening balance. Plus the dividends paid, obviously they are going to be a subtraction. We have dividends paid as a subtraction, and the net profit before tax is going to be an addition. And of course, we have tax, it's not yet subtracted, so we need to subtract it. So basically, this is what we have on this part. So if you calculate it on this part, you see that you're going to get your answer is 93,000 rands. Of this, we have 93 on B. So moving on to 1.1.10, the depreciation amount is dash when the depreciation is calculated at 15%, and I'm using the diminishing balance method. So we are using the diminishing balance method. The net carrying value and cost price of the asset is 120,000 and 200,000 respectively. So in this case, we are told that 120 is the carrying value. So here we are saying our carrying value, then our cost price is this one. Cost is this one, the figure that we have is 200,000. So diminishing balance, we are concerned about the carrying value as the formula for diminishing balance method. Depreciation, its percentage times carrying value. Where of course, if we are not given it as calculated carrying value, you would need to calculate it by saying carrying value is equals to cost minus accumulated depreciation. But in this case, we have it as calculated, we're given it as 120,000. So what are we supposed to do now? We are supposed to say our 15% times our 120,000. So we have 15% times 120,000. So we calculate and see what you get. So our answer becomes a C, which is 18,000 as indicated. So we have C. That's the correct answer. So this is what we've on a part of the multiple choice. And then the 1.2 reads, a financial statement and additional information of Trade Complete Private Limited for the year ended 31 December 2016 is given in the question 1.3. Use the statement and additional information to answer the following questions. What is the name of the statement below? So we try to see what statement are we given. We try to. So we have the statement as given. This is the statement that we are referring to. So the question is, what is the statement? So obviously, this is a statement of comprehensive income, which is the income statement. So a statement of comprehensive income is our response on 1.2.1, statement of comprehensive income. So we have a statement of comprehensive income as our answer. Then moving on to the second question, what is the purpose of this financial statement? Obviously, this is to find out whether the business is making a profit or loss, and that's the main um, use of the statement of comprehensive income, which is checking the financial performance of the company. So we have that SOS explained. So we are saying it determines whether the business made a profit or loss at the end of the financial year, or it determines the financial performance of a business. So basically, this is what we have. And then on the next part, saying what type of business ownership is Integral Private Limited. Of course, they are saying private limited, so it's a private company. So it's a private company, as indicated. So this is what we have. Then we move on to the next one, which is saying name the juristic body of organization responsible for the registration for this type of business. Where do they register these private companies in the CIPC? It's indicated. We move on to the next question. How is capital provided for this type of business ownership? So you'd say that obviously they issue shares, but the shares will be issued privately. So that's our response by issuing shares privately. And go to the next one. How is profit distributed in this business ownership? So you'd see that obviously dividends become a way to distribute profits. So, explanation was saying declaring a dividend according to the number of shares owned by the shareholders, of which we have also calculated the declared dividends previously. Then we go to 1.2.7, which other two financial statements should this business prepare or draw? So the question is just asking you other financial statements. Remember, we have other financial statements is statement of financial position, which is the balance sheet. We also have the cash flow statement or statement of cash flow, is also another financial statement. So we have them as listed: a statement of financial position, a statement of cash flow, a statement of changes in equity. So these are the other financial statements that you can include. Then what is the minimum number of owners for this type of business? So you see that we have got one. One. Then we go to 1.2.9, which act regulates this type of business, especially with regard to its registration, number of directors it can have, name, reservations, accounting records, etc. So this is the Companies Act. It is the Companies Act. So the Companies Act 71 of 2008 is an answer that you can provide. So moving on to the next question, name two examples of financial costs. So financial cost is a cost that relates to money, handling of money, as we take loans. What are the costs that we incur? So we check in terms of the list that we have with interest on mortgage bonds. If it's a bond, interest on bank overdraft. So we withdraw more money than what is in your account. You are supposed to be charged interest. Here's a payout for that. And then we've got interest on debentures, interest on loan. So these are all financial costs. So basically, this is what we've guys according to our theoretical part that we wanted to look at for this question paper, which can be part of our typical questions that you might face in the upcoming November exams. So I will thank you for listening, and hopefully the video was helpful. And please, let's not forget to subscribe and share. Thank you.